We opened May with a warning about stocks and why I was selling. We closed May with the stock market down 7% and no bottom in sight. Today I'm going to show you 5 strategies you can use to survive any stock market crash and actually make money. We're talking investing strategies today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. After 10 years of straight up stock prices, everyone likes to pretend that the stock market crash can't happen. Everyone wants to chase returns for just a little longer before they start protecting their money. Well, I'm going to let you in on a little secret about making money investing. Anyone can make money investing in a bull market. Returns fall from the sky like manna during a bull market. Creating long-term wealth, really growing your portfolio, is about not losing money when that stock market crash comes. Now, I've been pointing to the downside for the last few months, and we updated our 2019 stock market challenge portfolio at the beginning of May with my strategy for safety. Well, the S&P 500 just had its worst month since December and its worst May in years. Now, I'm not going to tell you we completely avoided the sell-off. Our dividend portfolio fell just under 4%, but it's still at a 17.9% return so far this year. That's more than 8% higher than the return on the S&P 500 and 7% more than the Vanguard Dividend Appreciation Fund. So that end April repositioning really helped save us from some of those losses, and it's hard to be anything but happy with an 18% return less than halfway through the year. Now I'm going to update on that dividend stocks and the funds in the portfolio, then reveal 5 strategies you can use to survive and even thrive during a stock market crash. I'm putting this video into our 2019 Stock Market Challenge playlist, so if you haven't seen those other updates yet, check those out. Along with some of the biggest investing channels here on YouTube, I created a $1,000 portfolio in January and will be tracking it all year long. To track my portfolio of dividend stocks, I'm investing $1,000 on M1 Finance, a no-fee platform that lets you pick your stocks and automatically invest any new deposits in the group. So I'll leave a link to the playlist of videos below in the description. Click through to see how we set up that portfolio and how I picked these dividend stocks. So here's our portfolio as of last Friday. 7 dividend stocks and 5 stock funds and a bond fund. Now I want to get to those 5 strategies for a stock crash, so I don't want to spend too much time here, but I wanted to point out a few of these. And I've added a column here also to show where the return was last month, just to give you an idea of which investments have protected our portfolio and what I'm looking at for opportunities. So you see at the top performers here in the portfolio, Hanesbrand, General Mills, Bank OZK, and ConAgra are all still above 30% on the year, though they've all come off their highs quite a bit. You notice though that General Mills is only off its peak by about 2%, so definitely representing that safety you get in consumer staple stocks. Now these next 5 is where I think we can get a lot of that insight that we learned over the last month. You'll see here China Life Insurance, ticker LFC, was up as much as 37%, but has fallen back to that return of 21% for the year. That's still not bad, but yeah, this thing has plunged on that trade war with China, and we'll see that again in our China fund. I've talked about this in some of our other updates, and I think this recent weakness in Chinese stocks is an excellent buying opportunity, especially if you missed that first big jump to start buying into some of these names. If you are a long-term investor, and I know a lot of you are, you absolutely must have some exposure to these domestic Chinese companies. It's not enough to own shares of U.S. companies doing business in China. You need to own some of these Chinese names as well, so I think you can get back into the market after this recent sell-off and pick up some of these names. Now these next 2 investments are golden lessons in diversification. We see that the Vanguard Real Estate Fund, that fund holding real estate companies, ticker VNQ, was all but immune to the sell-off we saw in May. At just over 8% of the portfolio, that was a big help in protecting our gains. Now everyone likes to talk about moving money into bonds or cash in the market weakness, but don't overlook the power of diversification by holding some of these real estate assets from those REITs funds as well. Same story here with this Alerian MLP fund, which holds those shares of master limited partnerships. Now, even on the weakness we've seen in oil prices over the last few weeks, this Alerian fund, the ticker AMLP, has lost only about 1% from its peak return there. Another example of diversifying your portfolio into different assets for protecting your money when stocks do drop. This bond fund, the Vanguard Long-Term Bond Fund, ticker BLV, is a position we added last month as well and did its job in protecting the portfolio. So that was 10% of the portfolio that actually made us over 4% during the month. This iShares European Financials Fund, ticker EUFN, is the biggest disappointment so far for the year, with the total return dropping to just under 4%. Now, I still think there's some opportunity here, but it might take a year or two for Europe to clear up some of those structural problems in the financial sector that's really holding it back. The iShares China Large Cap Fund, so ticker FXI, is another one that I wanted to point out. Just like China Life, this one has seen the return drop hard over the last month, and I think it's a huge buying opportunity for new investors to step in here and pick up some of these shares. Now, this fund is a little more heavily weighted to financial companies in China, so you might also consider the Spider S&P China Fund, ticker GXC, which owns Chinese companies but is a little bit spread out more across different sectors. The Spider Utilities Fund, ticker XLU, is another safety play that we put on last month, and this one hasn't done much over the last month, but it did protect our money like it's supposed to. Now, May was bad for the market, but it probably isn't the worst we'll see all year. The administration is fighting two trade wars simultaneously. U.S. economic growth is slowing, and there's really a very real possibility of an earnings recession this year. You cannot avoid these stock market crash strategies that I'm going to share with you right now. These 5 investing strategies will not only help you avoid the worst of a crash in stocks, they'll help keep your sanity when everyone else is freaking out and can even help you make money. The first strategy here is that your investing plan has to start with your goals. I know this doesn't seem like a strategy, but it's going to be vital to not stressing out when stocks crash and committing some of those worst investing mistakes that lots of investors make. When you start with your goals, and I'm talking about really sitting down to create a mental picture around your money goals, it takes the pressure off getting those double-digit returns every single year. You start to see the long-term picture and how your portfolio is getting you there, even if those returns fall short from one year to the next. Now, this is something we talk a lot about in our goals-based investing strategy, the one I created while working with private wealth managers. Creating that mental picture around that why of investing. So every time budgeting gets tough, every time the market gets nasty, you take that picture out and let it motivate you to stick to your plan. Now, I'll leave a link to a free webinar in the video description below where I lay out that entire goals-based strategy and how you can use it for a stress-free investing plan. This next strategy you need to be using is called dollar cost averaging, but that doesn't mean just chasing your losses with more money. Now, dollar cost averaging is just buying into your investments at different prices. The most common form of this is, say you buy a stock at $100 a share and then the price falls to $80. If you still like the company and you still think it's a good investment, you can buy more of those shares at $80, and that makes your average price between the two at $90 a share. Now, with this new lower average cost, you're still losing money on each share, but you don't need the price to go up quite so much so you're back in the profit. You only need the shares to go up that 12.5% to $90 instead of all the way up 25% back up to that $100 a share. Now, there are 2 problems with dollar cost averaging, though, that make it impractical or even dangerous for investors. First is that you need extra money to invest, right? You can't buy in at that lower price unless you have money set aside to buy in. Because most investors are fully invested all the time, they never have that option to take advantage of these lower prices. Now, I'm going to show you how to fix that problem in our next strategy. But first, let's look at that second problem with dollar cost averaging, and it's that investors never have a plan for truly taking advantage of this sell-off in stock prices. Now, what I mean here is that even if an investor has a little extra money to invest at the lower prices, they go all in after a 5 or a 10% correction. Stocks fall just a little and they put all their free cash to work. It's a little like investing in early 2008 after that first big market drop about 15%, but then you're fully invested and have nothing left set aside to dollar cost average lower. Instead, what I want you to do is make a plan for investing in different increments. So the specific points you invest in are going to be up to how bad you think the sell-off might get, the depth of the recession. Looking at this graph of the last 22 bull markets and market crashes, you see that the average crash has been about 27% from the peak and lasted 14 months. So if I were expecting an average recession, maybe like the signals we're getting right now, but not that huge bubble excesses we saw in 2008, then you might plan on saving money for investing when the market hits 10% lower, 20 and 25% lower. That's not going to save you from the big market crashes of 50% like in 2001 and 2009, but it will save you from a lot of the losses and prime your portfolio for when stocks rebound. Our next strategy, and this one is going to help solve that problem of not having any free cash to invest, is regular rebalancing your portfolio back into bonds and real estate. Now, you saw in our dividend portfolio how that real estate fund and the bond fund didn't lose anything during that May sell-off. In fact, the bond fund gained 4% on the month. Now, that 20% of the portfolio really saved us from the worst of the losses and could be used as a source for cash to buy in at these new lower stock prices. This rebalancing, so taking some profits out of your stock gains and getting that position in bonds and real estate, it doesn't have to be only when you're worried about a stock market crash. It's something that we've talked about on the channel, and this is something that you should be doing every year or two or instead. Part of that goals-based investing strategy is having a target for how much of your money you want in stocks, bonds, and real estate. So you start off with that amount, that percentage in these three assets, but after a few years of a bull market in stocks, that portion of your portfolio starts getting ahead of the others. So now instead of maybe having that 60% of your money in stocks, you've got 75% and much less in these other two assets. That's the time you need to rebalance back to those original targets, and it's going to do two things for your portfolio. First, when stocks do weaken, it's going to make sure that you have that cash available to take advantage of the lower prices. Second, though, it's also going to give you that peace of mind. Your portfolio matches those goals and that long-term plan and has the diversification in these three asset classes. You're not seeing your value jump up or down in a big market swings, and you have the confidence to know that your money is going to be there when you need it. Fourth strategy for surviving a stock market crash, and I love this one, is having different income sources and investments. So we talked a little bit about having different investments in our last strategy, and to this you might also add some alternative investments like P2P lending and crowdfunding. Those other assets are going to make your portfolio just a little bit more diversified for those less risk and higher total returns. And I think having the other income sources, though, is even more important and way underappreciated. By putting together just a couple of side hustles or some passive income sources, you not only give yourself that income insurance and never have to worry about a paycheck, you're also going to be adding to that extra cash that you can use to take advantage of lower stock prices when they do come. In fact, there comes a point where your income is high enough from the work and your other side hustles, you're actually hoping for a stock market crash. You've got so much cash coming in to invest, and you're excited about getting in at those lower prices. Now, to help you with this, I'm going to link to a playlist in the video description below. 5 videos going to show you 20 side hustles, many of them that you can do right from home and start with no money at all. Any one of these can make you thousands a month. So we're not just talking about a side income here, but something that can eventually potentially replace that rat race and get you that financial independence. So our fifth market crash strategy, and this is something we've talked about a lot on the channel over the last few months, is using these big macro trends and analysis to reposition your portfolio into that business cycle investing idea. Now, this one is probably the hardest of the 5, and while the others should all be used together, this is one that probably doesn't have to be in everyone's toolkit. If you just want to use those other 4 strategies, you're going to be very well prepared to protect your money and even grow it through a stock market crash. Now, using this strategy, though, is going to take you to that next level of analysis. It's about watching the business cycle, the economy, and the stock market. Now, a lot of people are going to say that you can't time the market. You never know when the economy is about to turn lower and when it's going to lead to a stock market crash. And I would completely agree. You'll never time the market to crash down to a day or even down to a month. What you can do is watch for these longer-term signals, the signs of a bubble in stocks with price multiples, the signs of weakening profit margins that could lead to an earnings recession. It's these financial signals that you can spot and can tell you when to adjust your investments to some of those safety sectors like utilities, consumer staples, and healthcare, like we've done with our stock market portfolio. Now click on the video to the right to see exactly how we set up our 2019 dividend portfolio to beat the market. I'm also leaving a link in the video description below to M1 Finance, that no-cost investing site I'm using for the challenge that's going to save you all those fees whenever you invest.